See, this chapter is a slight extension to the Black-Scholes model formula and all which we have dealt regarding the option pricing, right? So probably if I have to take that to start with, let's say I'm talking about a security, just as giving a quick update. Let's say I'm talking about a security whose current stock price is 2500. The strike price, let's say, is again 2550 for a call option. And let's say we are assuming that the risk free rate of return is somewhere around 8% annual. And the volatility in the security mentioned by Sigma is let's say around 25%. And we are talking about a time to maturity of 0.25 years, 3 months time to maturity. Using these five, we have used our Black-Scholes model to compute the price or premium associated with the call option. So we have first found out D1. Again, as a numerical also we can still take it. So if these are the five elements that are mentioned for our security, I can find out the price or the premium for this call option using two variables called D1 and D2. For finding out D1, we had a formula log S by X plus R plus sigma squared by 2 into T divided by sigma into square root of T. This was the formula to find out the D1 value, and the D2 value was nothing but D1 minus sigma root T, sigma into square root of T. These were the values for finding out D1 and D2. And then we were finding out ND1. This was the same thing which we have used for our normal distribution for finding out the price of the option through Black-Scholes model. This ND1 and ND2 in our exam, probably he may have to give the direct values for them, or he will give a small table for various values of D1. These are the corresponding ND1 values. So he may give probably right from 0.06, probably he may give a small table like right from minus 0.1 to plus 0.1. Some small table he may give minus 0.1 to plus 0.1, or probably he may give from 0 to 0.1, because the minus side is a reflection of the plus side because of the symmetry in a normal distribution. So in a table he may just give the values for 0, 0.01, 0.02 for various of these numbers. He may give you the corresponding normal distribution values. So even if it is for minus 0.06, if you find out for plus 0.06, that's the same value. Right, all we are looking at, let's say if I am trying to find out for ND1, right, we'll look at it in the table form also. If I am looking at ND1, this is the number. If I am looking at ND2, this is the number. Now we said the price of our call option is nothing but S into ND1, the current spot price, into ND1 minus the present value of the strike price. So this by e power RT into ND2. So 124 is being looked at as the price per this particular call option. The premium for this particular call option, it is expected to be around 124.82. Now, why are we talking about this in case of the discussion on Greeks? Greeks is a concept that is built on the top of this concept itself, saying if this changes by some extent, if the stock price changes by some extent, how would the call option price change? If the stock, now let's assume that this is 124.82, right? If the, so let me write it as 124 point, let's say 83, rounding it off. Now, if I make this 2501, stock price increases by $1 or 1 rupee, whatever it is. Stock price increases by 1 rupee. The call option price has actually increased by 17 cents there and another 35, only 52 cents, right? This is what, so what is the sensitivity of your call option price when some of the underlying features change? When some of the underlying entries change, by what extent is your call option premium changing? That is what is the typical output that is given by the Greeks. So if this is changing, there is one Greek. If this is changing, there is one Greek. If this is changing from 8%, let's say the interest rate becomes 8.1%. What would be the impact on the call option premium? Or if the volatility changes from 25% to 26 or 24, what is the impact on the call option premium? So the change in each of these is given a different name. So the change in the price is initially called as a delta. There are two major words, delta and gamma, both associated with the change in price of the call option because of the change in the price of the underlying security. Right? We'll see what is the difference between those two, but these two Greeks are more representing the change in the underlying security. What could be the impact on the call option or put option? When I am saying call option, put option is very easy to find out. What is the way I can find out the put option? I'll use call put parity relation. Right? We have used the call put parity relationship as C minus P is equal to S minus X by E per RT. So based on that, I can find out the value of the equivalent put option. The equivalent put option comes out as call price minus the current stock price plus X by E per RT. X by E power RT. X by E per RT. So this is also coming out somewhere around 124.32 only. Right? But now, if at all, let's say this is changing or the strike price is becoming 26. The call option is becoming 103, the put option is becoming 151. So call is coming down, the put is going up. So what we are now interested in is, as a part of the understanding of the Greeks, how sensitive is our option price with respect to the underlying price changes, whether it is a call or a put. So, I mean, with this, right now we don't have any as a part of our curriculum. There are lambdas and various other things that come up. But here, as far as our curriculum is concerned, we are looking at delta and gamma for that. We are looking at rho for this. if the interest rate is changing, what would be the impact on the option price? That is what is, so probably you can match R with a rho, the interest rate with a rho, the time with a theta, T and T match. This again, sigma is nothing but volatility, it's a V. So there is a Vega. So probably you can match these three things quite comfortably, right? The rate of interest matching with a rho, volatility matching with a Vega, and time to maturity matching with the theta. These are the 5 Greeks which we need to be comfortable with. Though in reality, there are a few more Greeks like kappa, lambda, kind of various other calculations for a trading purpose. But these are the most commonly covered kind of mechanisms. Now, if I get back, before we talk about these positions, there is a mention in this chapter about a naked position versus a covered position. Whenever we are talking about buying or selling, whenever we are getting into option position, I want to see whether the position is a covered position or a naked position, which means especially for a selling purpose. When I am getting into sell call is what? The person who has bought the call, option, he can decide when he can buy the shares from you. If he wants to buy the share, you need to sell it to him mandatorily. Now, if you don't own those shares, that is what you call as a naked position. You don't own the share. But if that guy, so what happens if the buyer of the call wants to exercise this option, you may not have the shares with you, which means you may be forced to buy it in the market and probably at a higher price, because that guy will exercise the option only when the market price is greater than the strike price. So if you don't own the shares, it may be so happening that you may have to buy the share from the market and sell it to him if there is a delivery kind of stuff. Or literally also your position will have a negative thing. So what we are typically saying is that kind of a strategy is called as the naked position strategy. But when you hold the share underlying, probably you might have bought it some time back at a different price. So your position is what we call as a covered position. I am covering for that. So even though the other person is planning to exercise the option, I have enough shares to cover for that position. So which means even though if it's not a physical delivery also, you will gain in that share position. You will lose in this position. Overall, it will not be a big loss for you if you already have the share with you. So that is what a typical stop loss strategy, what it says is to minimize the loss. What it simply says is the moment your asset price, market price rises above the strike price. Let's say we are talking about the strike price of 2500. Today the market price right now is 2480. What it says is to minimize your loss, the moment the market price crosses this 25, let's say 2502, 2503, you purchase the stock. So that if that guy wants to buy the stock from you, your loss is very, very minimal. You are covering it. So it's basically like you are covering when you think that there is a chance that this guy will exercise the option. You are uncovering yourself when you think that the market price is going down. You will sell off the share immediately. So the strategy is very simple. Don't hold the share forever. Right? Let's say you have put the strike price as this. The market price is going here. Just cross 25. Buy the share. When you have sold a call, this is only applicable when you have sold a call. Because the guy who has bought the call, now he will exercise the option. If he is exercising the option, there is a loss for you. Because I mean, only when the market price is going up, you will exercise it. But you are making sure that you have bought the share just at 2.5 and 2.502 or something. You are selling the asset at 2.500. So maximum you are losing some $2, but you might have gained a premium on the top of that. That is what we are calling as a stop loss provision. The moment you see that again this comes here, now you are sure that this guy will not exercise the option. So you immediately sell off the share which you have, so that you are selling it at a higher price and getting out. If the price even more falls further, that guy will not anyhow exercise it. But you are also losing on your stock. So better get rid of it. That is the typical stop loss preventing strategy. So coming to the various Greeks, what we are saying is delta is nothing but the change in the price of the option, any derivative for that matter. Right? You did not talk about only for options. For others, it is straightforward number. We'll talk about it. The change in the price of the derivative if the underlying is changed by $1. So in our example, what has happened here? If the underlying has changed by $1, the derivative, the call option, has actually changed by 52 cents. The call option has changed by 52 cents. So in our example, 52 cents is the delta for the call option. What is the change in the call option premium if the underlying changes by 1 unit? Now, if you had observed this 2500, we'll look at it for a put option. Look at it for put option. The original price is 124.82 or 32, 124.33. That is the price of the put option. When the stock price increases by $1, the put option becomes 123.86. So put option has actually fallen. And what is the difference? The difference is minus 0.47. So this is what we call as the delta of the put option. This is what we call as the delta of the call option. So what you can see here is delta for a call option is positive. Delta for a put option is negative. Because if the stock price increases, call option premium will increase, but the put option premium will decrease. The extent to which it decreases or increases is what is the measure of delta for us. Now, what does that indicate for us? If the number of shares purchased are equal to delta times the number of options sold. So, if you want to create a perfectly hedged position for this, so let's say you have shorted 100 options. You have sold 100 call options. Now, how many shares you have to buy to cover yourself, right? Naked versus cover. We earlier said the moment the stock price is rising above 2.5, you better buy the share. The moment it comes below it, you better sell off the share. Is it how many shares? 1, 2, 20, 100. What is the number of shares I have to buy? That what is being said is you look at the delta of the option. So for the call option, the delta is 0.52. Means you have shorted, let's assume that you have shorted 100. And so when you have shorted 100, what is coming out? Your exposure completely is the price is increased by 0.52 and 100 options have been shorted, right? And what it says is how many shares you have to buy to protect your position, to completely hedge your risk, is nothing but the delta times this, which is you buy 52 shares to protect your position. The reason being, when the share price is increased by 1 rupee, the call option premium has increased by 52 paisa. Correct? So let's assume you have 100 such 100 such call options. So the call option premium has increased by 52 rupees. So your share price also should increase by 52 rupees to really hit that position. So each share is changing by 1 rupee. So I have to hedge, I have to buy 52 shares to completely hedge my position. Getting it? So every time for a sell call kind of a mechanism, I have to really decide how many shares I have to buy or sell to completely hedge off my position. Based on the delta times the number of options sold is what will be the number of shares I have to buy to cover my position. Right? So in case we are talking about a forward contract or a few, so typically for a forward, you'll see, or even a stock, the delta is always 1. Because for a forward, if the underlying increases by 1 rupee, the forward contract also increases by 1 rupee only. So for a forward, the delta is always 1. A long position, probably these are some of the numbers you have to be comfortable with. When we are talking about a forward, for a long, the delta is always +1. For a short, the delta is always -1. For a future, the delta is always e power r minus q into t. Because we can, it's going on a day-to-day settlement kind of a scenario. Because of that day-to-day settlement, instead of taking 1 per it, we are looking at the delta as e power r minus q. Q is a continuous dividend, especially for index futures. When we are taking the dividend on a continuous basis, instead of directly taking e power rt, we are subtracting the dividend, the present value of, we are removing the present value of the future dividend. And because the dividend is on a continuous basis, we are doing it as e power r minus q into t for finding out the delta for a future position. But in case of options, it changes. For a forward, it's always 1. For a stock, it's always 1. But for an option, it may be much lesser than 1. Maximum value can be 1. But generally, it is much lesser than 1. Right? For a put, so in most of the cases, it lies between 0 and 1 for a call, 0 and -1 for a put. So you have to hedge your short positions, whether it is futures or options, by buying those many units of the underlying to either protect yourself completely or unprotect yourself completely. Either a naked position or a closed covered position you are doing by getting into that kind of numbers accordingly. So what we are typically looking at when we say delta neutral position, that is what is that position. So if I buy 52 shares in that earlier example, when I have sold 100 call options, so overall what is my delta there? Okay, for a long position, the delta is 0.52 for an option. into 100. So probably 52 is my impact on the short position, because I have sold calls. 52 is the impact on the short position. I have bought 52 shares. For a share I said delta is 1. 52 is the impact on the long position. So this particular strategy is what we call as a fully delta neutral strategy. I am making it as if delta is nothing but it's like a duration in a bond. The risk that is associated. If I am making it delta neutral, it's more or less like I have created a risk neutral kind of a strategy. Right? So when I am saying delta neutral, we are saying number of options and the underlying stocks that needs to go as a part of your portfolio. 100 options selling, 52 stocks buying as a portfolio will create my delta as 0. Right? But this has to be done on a daily basis. The reason being, now if you see, let me increase this share to 2502. Just for understanding purpose, 1 more rupee I am increasing. So what could very well happen is, now my call has become 125.88 almost. Now if I look at the difference, 0.53, the difference may change. Sometimes what happens is the difference might change, and we are talking about even the days to maturity, because of various reasons. If all others are even kept constant, the delta is not constant ever. The delta keeps changing with the price changing. So because of that, I need to, so now if it becomes 53, I have bought only 52 shares. So it's better that I add one more share. So that buying and selling of the number of shares has to happen on a dynamic basis. And that mechanism is what we are calling as a dynamic hedging, dynamic delta hedging mechanism. Delta neutral, you are making it on a dynamic basis. So every time you are observing the delta, and based on the observed delta, you are again playing around with your with the portfolio. Right? Then the next thing we are more looking at is theta, which is more to do with the time to expiration of the option. Now what we see is, again in this number, let me take this back to this. So this is my call option premium. Now let me say I'm going closer to maturity. So from 3 months, let's say we have moved to probably 89 days. One day we have moved closer to maturity. Instead of 90, I'll take 89 by 360, because 90 days by 360 I have assumed as a year for simplifying calculation. So let's say I have moved a little bit further towards the maturity. What I am seeing is the call option premium now is actually becoming 123.87. So the call option premium has got reduced by almost $1 or 96 cents is the reduction in the call option premium, with 1 day decrease in the time to maturity. The same thing probably has happened with the put option also. Right? The put option also has gone down by some extent, 123.92. Earlier, I think the put option was 124.33. Now it has become 123.93. Even the put option has decreased in the price. Even the call option has decreased in the price. So we have looked at it even in our comparison, that the closer I move towards the maturity, keeping all the other items constant, the more closer I am coming towards the maturity, the lesser will be the premium that is associated with the call option as well as the put option. Both the premiums will typically decrease. So that is where we are looking at the sensitivity of again both the call option as well as put option with respect to the time to expiration. So that's where we also call it as time decay of an option. As the time passes, call and put, both of them, they decrease in the value. And some interesting things is, it is very significant when the option is at the money. What you typically observe is the theta is very high. Theta is nothing but the sensitivity, by what extent. So these are the most important points to focus on. When the option is at the money, okay, I'll show you the example. You take here let's take 0.25 only. I'll put the strike price as 25. So spot price very close to strike price. So we can say that this is an at the money option. So in normal case, the call option premium is 149.68. Now if this becomes 1 day, if this is getting reduced by 1 day, you see the call option has actually become 148.71. There was a decrease by almost 97 cents. Whereas here the decrease was earlier, the decrease was only to the extent of some 92 cents or something. And probably instead of this, if I reduce it even more, let's say only 3 days to maturity. The better way to look at that example is, let's assume that there is a 3 days to maturity. 3 by 360. Only 3 days to maturity. The call option premium is 23.60. You reduce it by one more day. 2 days to maturity. Right? 2 days to maturity. The call option premium is 19.14. What is the decrease you are seeing in the call option premium? Almost call option premium decreased by 4.4. Initially by 1 day decrease, when we are talking of 90 and 80, a 1 day decrease has reduced the call option premium by 97 paisa. But when we are very close to maturity, a 1 day, now look at it with only 1 day to maturity instead of 2 days. Only 1 day to maturity. The call option premium is only 13.4. So 13.4 and 19.14, almost 5 plus, 5.5. So what we are saying is this statement. It is very significant. The theta, the change in the call option premium is very, very high when the option is at the money. Right? Why we are saying at the money? Now you look at this 2.6, which is out of money. I'll take the same example with 3 days versus 2 days. Right? We'll see the difference. 3 days to maturity, the option premium was 1.09 or 1.09 was the option premium. Whereas if we are talking of 2 days to maturity, the option premium was 0.32. So the decrease is not that significant. From 1.09 it came to 0.32. Almost some 70 cents is the decrease. Nothing more than that. The same thing you look at it when it is purely in the money. 2.4. So in this case the premium is 101.28, right, for 2 days. And you look at it as 3 days to maturity, the premium is 102.36. Even here also the decrease is just by around 1 rupee. But when the option was more at the money, you saw that the difference is 4.4 rupees. So that is what we are calling as theta. So probably for you to remember, when the option is more at the money and very close to expiration, the theta will be very, very high. And of course, when I say very, very high, negatively high. I mean, absolute value is very high, but I mean, overall the value is very, very low. Shape is like a U. Shape is like a U. This is where we are talking of at the money. Because the difference is minus 4.46. There is a drop. Significant drop. Right? So, when I try to plot a graph for different strike prices, what we see is a kind of a U. So it will be more and more significant at the money, but when it goes away from at the money, either in the money or out of money, we'll see that the theta value will keep decreasing. So probably even if this one line is remembered, we can try to answer the question comfortably. So it is usually negative, as we have seen almost all the cases. The more closer we are going towards maturity, the theta will, the call option as well as put option, both of them will keep coming down, which means the theta is generally negative itself. But there is a possibility for European deep in the money option. Probably instead of 2.4, I make it as 2000 deep in the money. There is a possibility of a very small positive value to come up. So probably if I am looking at 2000, the premium is 501.33. 501.33, and for 2 days to maturity 5000. I mean, there is a possibility, theoretically, there is a possibility that the theta can turn positive. But in very common scenarios, it will never turn positive. Then, we have been observing that the delta keeps changing every time, right? Just like the way in the case of bonds, the duration keeps changing with the interest rate because of the curvature. And the way we have measured the curvature is through convexity. The same logic gets applied here. The delta keeps changing for an option as the price changes. So that is where we are trying to use the percentage change in delta. Percentage change in delta, or probably change in delta to a change in price. That is what we are calling as the option gamma. Just like a curvature, just like a convexity, which we are talking in the case of bond, because even the option pricing also follows a curvature kind of a relationship. We have seen U curve with the theta. So with the price also, when I try to plot a graph, right, for different underlying price, right, so probably it's like this, right? When I take the stock prices right from 2400, let's say I am taking the stock prices right from 2400 to, let's say, 2600, some number. For every stock price, I want to find out what is the corresponding price of the call option. What is the corresponding price of the call option? I want to See, what I am trying to drive is for the gamma. Now, when my stock price is changing like this, I want to check out how the option price will change with this. So, if I look at the call option premium for all these possibilities, if I want to look out for the call option premium, all I can look at is so this is my call option premium in all these scenarios. So right from 400 it is increase the stock if the stock price is getting increased from all these numbers, or probably I think I have to change something else here. This is, let's say, 90 days to maturity. 90 days to maturity, if I keep this number. So this is my call option. No, even the strike price, let me make it as 2550. So this is happening to my call option premium across. Now what I would like to do is, if I try to plot a graph for these numbers, if I try to plot a graph for these numbers, what I will simply observe is this graph is purely not a straight line. There is some kind of a small curvature that is built into it. So because of that curvature, what we are saying is the delta is not uniform across. If this had been a straight line, the delta would have been completely uniform. But because of this curvature in the graph, we see that the delta is not uniform. It changes with the price. So wherever it is changing with the price, that is what is a measure of gamma for us. Percent or change in delta with respect to change in price is what we are calling as a gamma of the option. Whatever is the curvature which is not captured. So probably you should equate it more or less in terms with duration and convexity for the bond. So whatever is the change that is coming out which is not captured by delta because of the curvature, we are computing separately as gamma. So some of the key things about the gamma is, if the option is deep in the money or deep out of the money. So which means the strike price is either, if the stock price is 25, probably strike price way away from 25, either on the lower side or on the higher side. They don't have much effect on the gamma at all. Whereas at the money, again, at the money will have a very huge impact on the gamma. So probably with theta, with gamma, at the money will have a high impact. And what does that mean? If the gamma is very high, the change in delta, because the way we are defining gamma is what? Change in delta to change in price. Gamma high means with the same $1 increase, the change in delta is very fast. It's not delta is increasing. The change in delta is very fast. Either it could be on the higher side or on the lower side. Delta is increasing fast. So it's not delta high. There is a difference between these two. I'm not talking about delta being higher. Delta is changing fast. So probably earlier if the delta was 0.52, it is becoming 0.57, 0.62, 0.67. There is a huge change in delta with a small change in the stock price. Or it could be on the downside, 0.47, 0.42, right? It's the acceleration part. Yeah, you're right. It's the acceleration part that is higher on the positive side or on the deceleration on the negative side. That is what is measured by gamma. So if there is a huge gamma also associated, we have to use both gamma and delta together to hedge our portfolio rather than focusing only on delta hedging. Right? So there are again theoretically there are some formulas associated with the computation of gamma and delta, right? But what I typically believe is we are more bothered because they are derived from the differentiation of the Black-Scholes equation. So rather, I mean, one way is we can mug up those formulas, or generally, I don't expect a question to be created based on those formulas. It's more of an what I have been observing is it's the interpretation side which is more and more focused rather than the calculation aspects with respect to gamma. In case we are seeing any kind, and I think there are some formulas that are mentioned which can be derived. See, they are typically, see, they cannot be computed also unless he gives us the value. Because he is saying here, the formula for a gamma, again it can be derived from the equation, but do a differentiation of nd1 and divide it by s naught sigma square root of t. This is the way the formula for gamma is computed. In reality, when you have the system, all you need to do is this particular aspect to arrive at your gamma. But typically, he has given a kind of a formula to compute the gamma. But for that also, he has to give all these numbers explicitly. We don't have a mechanism to compute n dash d1 and all. So he has to give the values for all of them. Only then you would be able to compute your gamma value. So I don't think there will be a stress on numericals, especially on these kind of formulas. It would be more of an interpretation aspect, saying where would the gamma be maximum, where would the gamma be minimum, right? What could be the impact of gamma being large? So the focus should be more from that analysis standpoint. And if at all in any of the numericals, when we are dealing with them, if there is a specific numerical that asks for questions on this, we'll take up those questions on a piece by piece basis. Then we are also talking about Vega and Rho. Again, if the volatility is changed, let's say from 25%, my sigma is increased to 26%. A 1% change in the volatility. Here I can look at percentage. Volatility increased by 1%. What could be the increase in the call option price? Or what could be the decrease in the call option price? People will predict what could be the volatility after few months, after few days, or after few weeks based on the Vega trading. Based on the Garch model or any other volatility prediction models. Based on that, they will predict what could be the volatility in the future. And based on that, they may get into the trading process because this would be the volatility now, this would be the volatility then. So probably a kind of arbitrage model is what that is getting created on the top of that. So that's what will give me the Vega trading mechanism. And the next is, so here, because in case of volatility, always we will be seeing that the Vega of the call is always equal to the Vega of the put. If the volatility is changed by 1%, both the call as well as put, they increase by the same mechanism. So that's where we say Vega of the call, if all others are constant, Vega of the call is more or less equal to the Vega of the put. One important relationship. And again, this is also very sensitive at the money. All of them are more pronounced at the money and they become more and more weaker when you are going away from money. The only thing you have to remember is theta is one value which is more negative at the money, right? Higher but on the negative side, whereas for others they are more positive on the higher side itself at the money. Even the rho is with respect to interest rates. Probably this is one thing we don't need to bother too much because the sensitivity is not that high. If the interest rates are changed by 1 basis point, the call option premium may not get affected that badly. So one of the most flattest kind of impacts as far as the equity options are concerned. But the same thing will have a very big impact on fixed income options or probably interest rate options, because the underlying itself is interest rate in some form. But for equity options, stock based, index based kind of options, you don't see much bigger impact with respect to the row. So these kind of relationships, again, here the in the money calls and puts are more sensitive. So it is like an increasing thing. The row will be higher. This is not at the money. It starts very high for in the money and gradually comes down. That is the sensitivity of with respect to the rho. But for all others, Vega, theta and gamma, they are all very significant at the money, and they become more and more weaker the more you move away from at the money. We talked about delta neutral position or gamma neutral position. Delta neutral is make the overall net delta equal to 0. In a gamma neutral also, especially when there are options, see, in some cases because of the gamma, the curviness nature, what you typically find is the delta keeps changing very drastically. So because of that, you may have to buy more securities or sell more securities quite drastically to address for that gamma also. So gamma plus delta, which again, if you are looking at the number of options that must be added, is based on the gamma of the existing position, whatever the number of options plus number of stocks, whatever the position you have, you find the gamma of that position divided by the gamma of the options that you are trading. New option, let's say I want to buy a call option, right? Or I want to sell a call option. Look at the gamma of that call option, right? You use this formula. Negative means you are going for a short position. Positive means you are going for a long position. Which sometimes it could be an offsetting position. If you have already shorted so many call options, then you are buying back or longing or offsetting some of those short calls and reducing the number of outstandings. So this is one example which these guys have given again as a simple relationship that exists between the various Greeks. The row times the portfolio value is equal to just one. Theta, sorry. This is theta. The row times the portfolio value is equal to theta plus again row times the spot price times the delta plus 0.5 the volatility square times the spot price square times the gamma. So if at all one value is given and the other needs to be found out, we can use this kind, or probably if 3-4 values are given and you have to find out the fifth value. So because here the variables are theta, rho, the stock price, the delta, the gamma, the sigma, and even the value of your portfolio. So these are so many variables that are there. If one unknown is there out of these variables, you can use this kind of a relationship to typically find out what should be the existing delta or what should be the existing gamma or whatever it is. Now, when you are saying your portfolio is already delta neutral, so sometimes what he may do is, for you in the exam, he may give the scenario, okay, the portfolio is delta neutral or portfolio is gamma neutral. Find the others. So when it is delta neutral, this resulting delta does not exist anymore. Delta is 0, so this amount will become 0. So probably your formula is reducing to Rp equal to theta plus 0.5 sigma squared S squared G. So he may give you 1 or 2 or 3 or 4 of these values and he may ask you to compute the rest. So some such kind of basic or probably he may ask you if keeping everything constant, if the gamma is if this gamma is increased by some amount, what could be the impact on the portfolio? Some such kind of assumption based questions also might come up. So just one relationship to remember which can solve the calculations across. I don't think again a numerical will come on this, but just to be on the safer side, it's better to remember the relationship. Again, more of an analytical piece may come rather than any calculation kind of a piece. So generally the delta neutral positions are very basic things which every organization will typically implement. Most of their portfolios, they try to implement by basic thing, they implement a delta neutral position and keep monitoring the other Greeks. What is the kind of, because the major thing is at least make it delta neutral. In some cases, they will make it gamma neutral also. But a few more things that have typically been observed, if there are companies which have sold options, call option or put option, they are exposed to negative gamma and vega. The reason again being, from a buyer standpoint, we see that the gamma is more predominant at the money. So from a seller standpoint, they are exposed more and more to negative gamma. The more it is at the money, there is a chance that it will be exercised. And the gamma for a seller position is always negative. So what he is saying is the gamma, wherever the sell call kind of a scenario is there, where gamma is significant at the money, from a buyer's position perspective, right, we are saying that it is positive. But from a seller's position perspective, it is negative. Right, for a buyer, we said the more at the money, this is the way the gamma will be there. This is from a long position. From a short position, this could be the gamma, this could be the vega. So what we are saying is, this, when you are getting into a sell position, you are exposed more and more to negative gamma, and it can become more and more negative as the time passes also. Time passes is we are coming closer and closer to maturity, which means an impact of both gamma as well as theta. The exposure is becoming more and more significant also because of that. Right? Because the more closer you are coming to maturity, we have already discussed that the drop in the price is going to be more significant. Right? So a few of these kind of relationships, when the options are initially sold at the money, the level of sensitivity to gamma and vega is the highest at the money. But the more you are going in and out of money, the impact of gamma is typically going down. So these kind of relationships, the farther or out of the money, gamma, vega, all of them will have very less impact on the exposure for you. So these kind of relationships, if you are able to maintain, if you are able to remember, I hope the questions can easily be answered from this space. So the another thing on using derivatives as an insurance. So typically this protective put mechanism, wherein long stock plus long put is what is being looked at as a portfolio insurance mechanism. Whatever is the worth of your portfolio, when I say stock, the complete portfolio what you have. on the worth of the portfolio, take put options. So which means it's actually the concept is more like an insurance itself. If you see what happens in an insurance, I'm paying some premium. The premium, you look at it as a premium which you are paying to purchase the put option. Now on the top of it, what happens when a loss occurs? A loss settlement is what is coming up. So when the value of the stock or the portfolio goes down, that is the scenario of a financial loss occurring, the put option is going to bridge your loss. It is going to pay for the loss. So the concept wise, when I'm typically, when we are not at a loss, it will not do anything. Just like you have just paid the premium and nothing is happening. The same thing is happening even in case of put option also. When your portfolio is increasing in value, the put option doesn't do anything, right? So from that standpoint, we say that this is, the combination of a long put with your underlying portfolio is what is the scenario of replication of insurance. And what we are saying is sometimes the put can be created synthetically also. If you have remembered our call put parity relationship C minus P equal to S minus X by E per RT, the P can be created with the remaining 3. So put can be created even without a put. So either way, even if you are directly going for a long put or you are replicating it through the other combination, as long as you are able to create a long position in put, we are creating a portfolio insurance kind of a hedging strategy.